Small accounts are tricky. They're fragile. Every loss feels bigger than it is. Every win feels tiny. And yet, small accounts hold an incredible advantage. They can grow faster than larger accounts if approached correctly. The difference between failure and breakthrough is discipline. Discipline is not just following rules. It's controlling impulses. It's managing emotions. It's staying consistent when the market tests you. Many traders with small accounts fail not because they don't know strategies, but because they treat trading like gambling. They chase setups, double down after losses, and trade without structure. But disciplined traders turn these same accounts into real profits. How? By sticking to process over emotion. Discipline begins with risk management. Small accounts cannot survive big losses. You may hear stories of traders going all in and doubling overnight, but those are exceptions, not rules. A single bad trade can wipe out months of progress. Discipline is saying no to risk that is too large. It's sticking to predefined position sizes. It's taking losses calmly and moving on. The next element of discipline is patience. Many small account traders feel the need to do something constantly. Every market move seems like an opportunity. Every candle looks important. But the truth is that the best trades often take time to appear. Patience allows traders to wait for setups that meet all criteria. Not just almost setups, not just the hope trade. Small accounts are especially vulnerable to impatience. Every missed opportunity can feel like a loss, and every winning trade seems insignificant. But disciplined traders understand that missing trades is part of the game. Next is consistency. You may have a strategy that works 60–70% of the time. Success doesn't come from being right once or twice. It comes from applying that strategy over dozens, hundreds, and thousands of repetitions. Small accounts grow slowly at first, but disciplined execution compounds over time. Every proper trade builds confidence. Every avoided impulsive trade preserves capital. Every day you follow your rules, your account strengthens. And the last part of discipline is emotional control. Small accounts magnify emotions. A small loss can feel catastrophic. A small win can feel euphoric. Discipline teaches you to neutralize these emotions. You don't celebrate every win. You don't panic over every loss. You follow your plan because you know the system works over time. Emotions are noise. Process is everything. Discipline turns small accounts around because it eliminates self-sabotage. When every decision is measured, calculated, and controlled, the account has room to grow. When impulsive trades stop, losses shrink. When patience takes over, opportunities are maximized. And that's where the transformation begins. Small accounts aren't about fast wins. They're about consistent application of discipline, day after day, week after week. Most traders fail because they treat small accounts like they're trying to get rich fast. Discipline turns the account into a vehicle for steady growth instead. Discipline doesn't just prevent losses, it compounds gains. Small accounts grow slowly, but that slow growth is powerful. Every disciplined trade builds momentum. Every avoided impulsive trade preserves capital. Think about compounding. A $1,000 account that gains 5% consistently per week grows differently than a trader trying to double overnight. Impatience creates risk creates losses, and losses wipe out progress. Discipline ensures that each gain counts. Each loss is controlled. Another challenge for small account traders is mental traps. The first trap is overtrading. Small accounts feel like they need to do something all the time. Traders chase setups that aren't there. They enter trades impulsively, thinking each move is critical. The second trap is revenge trading. One loss triggers the urge to recover immediately. The trader increases position size or chases the market, often making losses worse. The third trap is focusing on dollar amounts instead of percentages. A $50 loss on a $500 account feels huge, even though it's just 10%. Discipline teaches you to measure risk in percentages, not dollars. The fourth trap is emotion-driven trading. Small accounts magnify fear and greed. Without discipline, Emotions control every trade. With discipline, emotions are managed, and decisions remain objective. Let's look at an example of a disciplined small account trader. Imagine a trader starts with $2,000. They risk only 1–2% per trade. They follow their strategy carefully. They avoid impulsive trades. They let winners run and cut losses quickly. It's not glamorous. There's no excitement. Some days feel boring. But after several months of disciplined trading, the account has grown steadily, maybe to $3,000, $4,000, or $5,000. This may seem slow to beginners, but this is how small accounts survive and eventually thrive. One undisciplined trade could have wiped it out, but discipline prevented it. Discipline also helps handle drawdowns. Small accounts will always experience them. Markets aren't smooth. There will be losing streaks. Discipline allows traders to stick to their rules, even in these periods. Instead of panicking or abandoning their strategy, disciplined traders follow their plan. The account survives the drawdown and is ready to grow when the next opportunity appears. Another key point: patience compounds profits. Discipline teaches traders to wait for the best opportunities. They ignore almost setups and avoid impulsive entries. Over time, these small advantages accumulate. Even small edges applied consistently create significant results. And that's the hidden power of discipline for small accounts. It turns volatility and risk into opportunity. It transforms fear into confidence. It converts impulsiveness into systematic growth. By sticking to rules, controlling risk, and managing emotions, small accounts turn around, not through luck, not through massive wins, but through consistent, disciplined execution. Discipline is not just about individual trades. It's about building a mindset that sustains long-term growth. Small accounts turn around when traders stop thinking in terms of instant profits and start thinking in terms of process, rules, and consistency. The first mindset shift is understanding that slow, steady progress compounds. A $1,000 account doesn't become $10,000 overnight, and that's okay. Every disciplined trade, every controlled loss, and every patient wait contributes to a bigger picture. The second mindset shift is embracing small wins and small losses. Small accounts magnify these, making them feel emotional. Discipline teaches you to normalize them. A loss is just a data point. A win is just the result of following your plan. The third mindset shift is removing ego from trading. Small accounts cannot afford ego-driven trades. Discipline allows you to trade objectively. You don't need to be right. You only need to execute the plan. Let's look at another example. A trader with a $3,000 account risks 1–2% per trade. Over 1 week, they place 5 trades. 3 are winners, 2 are small losses. Instead of celebrating the wins or blaming the losses, they record the results and analyze. That process builds confidence, patience, and habit. Over months, this approach compounds. The account grows, confidence grows, and impulsive behavior shrinks. Discipline also builds habits that last a lifetime. Small account traders who develop routine, process, and emotional control will carry these habits as their accounts grow. It doesn't matter if the account is $500, $5,000, or $50,000. The same principles apply. The key practical takeaways for turning a small account around: risk management. Never risk more than 1–2% per trade. Patience. Wait for high probability setups that meet all criteria. Consistency. Execute your strategy the same way every time. Emotional control. Treat wins and losses objectively. Avoid impulsiveness. No revenge trades, no chasing, no overtrading. Record and review. Track trades, analyze results, and refine your process. Small accounts are fragile, but they are also highly flexible. A disciplined trader can recover from early mistakes. They can survive losing streaks. They can grow steadily, safely, and effectively. The transformation is gradual. It requires patience and trust in your rules. But discipline turns small accounts around because it eliminates the factors that destroy them: impulse, emotion, impatience, and inconsistency. In the end, Small account traders who embrace discipline don't just grow their accounts, they grow themselves. They develop confidence. They develop patience. They develop habits that carry them through larger accounts and more complex trading challenges. And that is the ultimate power of discipline. It turns fragile small accounts into strong, growing, and resilient trading systems. It turns mistakes into lessons, losses into learning, and small beginnings into long-term success. Discipline isn't glamorous. It isn't exciting. But for small accounts, it is everything. If you want to see real results, start with rules. Start with patience. Start with emotional control. Start with discipline. Follow the process, and your small account will not just survive, it will thrive.